Okay. Hello. We're going to talk about receivables today. And the main focus of our discussion is on accounts receivable and notes receivable. But there are other types of receivables out there, and we're simply going to briefly talk about those. If you loaned money to someone, you would have interest receivable. Okay? If you paid too much in taxes, you could have a tax refund receivable. If you made an advance to an employee, you'd have a receivable from employees. And there could be other miscellaneous types of receivables. Not a big issue. Our focus today is on accounts receivable and notes receivable. Okay, there's two issues. There's recognition of revenue and the receivable. And we talked about this in a previous lecture. It's relatively simple. When we make a sale, we debit accounts receivable, which I simply call AR, and we credit sales or sales revenue. In the event I'm a service-based industry and I provide service on account, they're not paying me right at the moment, debit accounts receivable, credit service revenue. Pretty straightforward. Remember, revenue recognition says we don't record revenue until we've earned it if we provide service or when we've transferred the product. And then we record revenue and the related receivable. The bigger issue with accounts receivable is the valuation issue. And because we're extending credit, unfortunately, not all of our customers are going to pay us. And so we have to assign an appropriate value for accounts receivable, which takes into account those receivables that we're probably not going to collect. People don't pay us for a wide variety of reasons. They lose their job, they move, they forget, they die, who knows? Okay, but in any business where there are receivables, you simply have to accept the fact that you're not going to collect all your receivables. Okay? Now, your credit policy is the single biggest issue in terms of how big your bad debt is, or your uncollectible receivables are. If you have easy credit, like a lot of credit cards, they have a lot of bad debt. But they know that by extending credit to a wide variety of people, the majority of people make an honest stab at paying their bills, and so that the profits they receive from those additional sales, they hope and they've calculated will offset the bad debt from the uncollectible portion. So it's a balancing act. The other part of your ability to convert receivables is your collection efforts. How assertive are you in following up on old receivables, making follow-up calls, visits, etc. So your credit policy and your collection efforts play a large role in how much of your accounts receivable is considered uncollectible. Speaking of uncollectible accounts, they go by several names. They go by uncollectible accounts, doubtful accounts, bad debt, and I'm going to use the term bad debt more frequently, but recognize that they're the same concepts. Okay, so we have total accounts receivable, sometimes called gross accounts receivable. Then we have to subtract what we call the allowance for bad debt or doubtful accounts or uncollectible accounts. And this equals net accounts receivable. And we refer to this net accounts receivable as the net realizable value, sometimes called the cash realizable value, or NRV on the slide. GAAP requires us to report accounts receivable at its net realizable value. Think of it this way. Here's my total accounts receivable. This is the portion of receivables that we think we will not collect, the bad receivables, and that leaves the good receivables. Okay, let me give you an example that illustrates why this is important. Suppose we have two companies, Company 1 and Company 2. Company 1 says, I have accounts receivable of $1 million. My customers owe me $1 million. Therefore, my receivables are $1 million. Company 2 says, I have accounts receivable of $1 million, but I estimate that about $30,000 of my accounts receivable, I'm not sure if I'm going to collect it. There's a good chance I won't collect it, but I feel pretty confident that I'll collect $970,000 out of that $1 million. Company 2 is providing us a more complete picture, more accurate information, and a more conservative estimate of what the value of our accounts receivable are. This is more reliable information, and it builds confidence in the people who look at our financial statements, the people who call the users of our financial statements. For this reason, GAAP, generally accepted accounting principles, requires us to report accounts receivable at the net realizable value after we've subtracted uncollectible accounts or bad debt. Okay, and notice on the balance sheet, we have to report AR at net realizable value. Now, we have two different ways to account for bad debt. One is an acceptable method, and one is not really an acceptable method. However, we sometimes see it because companies that have relatively small accounts receivable, or if it produces results for a particular company that are comparable to the allowance method, then we can use the direct write-off method. The direct write-off method, which GAAP doesn't really allow, unless you've got very small or immaterial amounts of accounts receivable, basically says when we specifically identify an actual account that is uncollectible, then what we're going to do under the direct write-off method is we're simply going to debit bad debt expense and we're going to credit accounts receivable. That's my journal entry to write off a specific account under the direct write-off method, which again is not really an acceptable method. And notice the slide says it violates the matching principle or the matching concept. And here's why. Let's assume, okay, that on November 28th, we make a sale on account. And I hope you can read that. So here, the little dot here is November 28th. We make a sale on account. Now, this is the month of November, December, and right here is December 31st, the end of our business year, what we call the end of our fiscal year. Now, on December 31st, assuming I give my customers 30 days to pay their bills, this receivable, which the sale was made on November 28th, is only 3 days past due. I'm not willing to call that bad debt because it's 3 days past due. That's no big deal. Now, here's January, February, March, April, May. Come June 1st, if I still have not collected this receivable, now this thing is 1, 2, 3, 4, 5, over 6 months old. I've sent them 4 different bills. I've even called them on the phone. I still haven't collected. At this point in time, companies establish policies where they simply say, you know what, we've tried. We're not going to get paid. And they either write it off, or they write it off, but they send it to a collection agency. And then that person's credit, of course, is been impaired, and their scores go down. Okay, but the problem is that notice the sale took place, let's just say this is 2010, November of 2010. So that's when the revenue gets recorded. But the expense, right here, debit, bad debt expense, credit AR, that doesn't take place till June of 2011. We didn't match the expense to the same time period that it relates to revenue. This expense relates to this sale on account. Had that been a cash sale, we wouldn't be having this conversation. So, expense recorded in 2011, revenue recorded 2010, that violates the matching concept, which is one of the 2 basic rules of accrual-based accounting. For this reason, we're not supposed to use the direct write-off method. Some companies do when they have small receivables, but for the vast majority of companies, we have to use the allowance method, and that requires us to estimate what our bad debt is at the end of each fiscal period. Okay, so let's take a look at the allowance method. Okay, we're going to assume that accounts receivable is $500,000 at the end of our first year of business. We've been in business 1 year, the end of that year. AR is $500,000, and we estimate about 6% of our accounts receivable is uncollectible. How did I come up with 6%? Well, for a brand new business, I would simply have to use what's called industry data. What happens to other companies in this industry who've been around for a while? Okay, because I don't have any past history in order for me to create my own past track record. After a few years, I can look at my past history and I can see what portion of receivables went uncollectible. If I'm unhappy with 6%, I got to tighten my credit policies and I have to improve my collection efforts. Okay, we'll assume that 6% is normal and we can tolerate that amount. Okay, so at the end of year one, accounts receivable is $500,000. I multiply that times 6%, and at the end of the year, I have an adjusting journal entry. Remember, an adjusting journal entry, one account hits the income statement, one account hits the balance sheet. So I debit bad debt expense. That goes on the income statement. And that, by the way, an expense is a temporary account. It gets closed out. It gets set back to zero. And then I credit the allowance for bad debt. Your book, whatever textbook you may be using, is called the allowance for doubtful accounts or allowance for uncollectible accounts. And that is a contra asset that goes on the balance sheet. Okay, so I'm going to draw a T account for the allowance for bad debt. I'm just going to simply call it the allowance for bad debt. And we have a balance of $30,000 on December 31st, I'll just say 01, our first year in business. Okay, so adjusting journal entry gets recorded. We have to estimate bad debt expense for this year to match the expense to the same time period that the revenue was generated. Okay, so my accounts receivable of $500,000 is predominantly from sales that took place for the last few months of the year, although it may have some credit sales that took place in the summer or perhaps the previous spring. But mostly it's going to be most of my fall sales. Okay? Companies keep what's called an accounts receivable aging report, which shows all my receivables, and it breaks down columns based on how old each receivable is. Most of your receivables typically end up in the not yet due column, which means the sale was made within the last 30 days. Then you have 31 to 60 days past due, or 1 month past due, 2 months past due, 3 months, greater than 3 months, 6 months, etc. Okay? And the general rule is the older an account receivable gets, the less likely you are to collect it. And based upon how old my various receivables are, I come up with percentages that I estimate are uncollectible for each column, for 1 month past due, 2 months, 3 months, 4 months, etc. And the older they get, the greater the percentage of that dollar amount will be uncollectible. In my example, the 6% is simply what we'll call a weighted average of all those accounts. In total, about 6% of my receivables I believe will be uncollectible. Okay? So, using these numbers, let's take a look at the slide here. In the following year, we identify specific customer accounts that are long overdue, and we write them off with the following journal entry. We debit the allowance for bad debt, and we credit accounts receivable. Now, all this journal entry is doing is cleaning up our records. We've given up on this receivable. We don't honestly think we're going to collect it, so we're removing it from our accounts receivable ledger by debiting the allowance and crediting accounts receivable. This account was included in this estimate. I don't know who specifically isn't going to pay me. I simply know that X% of my customers aren't going to pay me. It's just the nature of our business and most businesses. Okay, so as in the following year, I identify bad accounts that have been out there for 5, 6, 7, 8 months. I start to kind of shake the tree, and out come the bad apples, and I write off these particular accounts. Okay? Notice how the debit will reduce the balance in the allowance account. If I have a $30,000 credit balance, and again, the allowance for bad debt is a contra asset, which means it has a normal credit balance. These assets have a normal debit balance. Contra, opposite, has a normal credit balance. As I identify particular accounts that are uncollectible in the following year, okay, so this is during the second year, I identify all these various accounts, okay? Now, at the end of the second year, I add up all the specific accounts that I identified as uncollectible, and I compare it to what I estimated at the end of the first year. Okay? If the previous year's estimate is too much, we will have a small credit balance left in the allowance account. If we underestimated bad debt in the previous year, we would have a small debit balance. We'll take a look at what that means. Okay. At the end of year one, we had a $30,000 credit balance. Now, let's suppose I add up all of these particular accounts which I decided were uncollectible, and I wrote off, again, by debiting the allowance for bad debt, crediting accounts receivable, and let's just assume that all these added up came to $29,400. I had estimated $30,000 were uncollectible. In the following year, I identified $29,400 of actual accounts. That would leave me with a $600 remaining balance, or leftover balance, at the end of year two. And notice, before we estimate bad debt for year two. Okay, so I'm writing it twice because it's very important. So I now have this $600 remaining balance. It's a credit balance because I slightly overestimated what was uncollectible. Had this number, instead of 29.4, been 30,700, for example, I would have a $700 debit balance because I slightly underestimated bad debt. And we need to know this because it's going to affect future years' adjusting entries at year end to record bad debt expense. Okay, so we have a $600 remaining balance at the end of the year two before we calculate bad debt expense for year two. So let's see what happens in year two. If at the end of year two, the balance in accounts receivable is now $600,000, because remember, in year two, we're continuing to make sales. Hopefully, we're growing our business, so our balance increased a little bit. That's a good thing. And we believe that 6% is still an appropriate percentage to use for bad debt. Then the adjusting entry to record bad debt is, and notice, debit bad debt expense $35,400. How the heck did we come up with that? Credit the allowance for $35,400. Let's see what happened. I'm going to erase this since we have that on the previous slide. Now, December 31st of year two, I multiply 600,000 times 6%, 0.06, and what that says is I believe that there's a total of $36,000 within accounts receivable that is uncollectible. That's what the balance in the allowance for bad debt should be at the end of year two, because that's what's going to go on the balance sheet for year two, December 31st. If I had a $600 leftover balance in the allowance, remember, the allowance for bad debt is a balance sheet account. We don't close it out. Bad debt expense gets closed out at the end of each year, not the allowance. If I have a $600 remaining credit balance and I want to end up with a $36,000 credit balance, then my adjusting entry is $35,400. 600 plus 35,400 gives me 36,000. So my adjusting entry is debit bad debt expense 35,400, credit the allowance for bad debt 35,400. Okay? Bad debt expense goes on the income statement. Okay? My allowance now reflects 36,000, which is what I believe the appropriate balance is at the end of year two, and all is well. Notice at the bottom of the slide, if the allowance had a remaining debit balance of 400, I'll tell you what, I'm going to create a different account here. Here's the allowance, I'll just abbreviate, and we have a leftover debit balance of 400, and at the end of year two, I want to have 6% of my receivables in the allowance. I want to have a $36,000 ending balance in the allowance for bad debt. Then my adjusting entry would be $36,400. Debit bad debt expense $36,400, credit the allowance for bad debt $36,400. Okay? So it's important as to whether any remaining balance in the allowance is a credit balance or a debit balance, because it's going to affect what my adjusting entry is. Okay, so you have to be comfortable with that. Now, let me just give you a little diagram that you may find useful up here. Let's suppose, okay, let me just kind of separate this. Here's 0, and this represents the debit side, and this represents the credit side. And here is $36,000 credit. If I have a $600 credit balance, then I would need to add $35,400 to get from 600 credit to 36,000. If, however, I have a 400 debit balance, I would have to first credit the account for 400 just to get to 0. Then I'd have to add another 36,000 to get to a credit balance of 36,000. So to get from here, I'm going to have to do it this way. Okay? This would be 36,400. Okay, so hopefully that helped. If it didn't, oh well. Okay, so it matters again what the remaining or leftover balance is in the allowance account before we make the current year estimate for bad debt based on a percentage of accounts receivable. I'm going to erase this thing. Okay. Hopefully that makes some sense to you. Review the information, reconstruct the numbers, and hopefully you'll be okay with it. Next, we're going to talk about notes receivable. A note receivable is also a receivable, but the difference between accounts receivable and notes receivable is that an account receivable is kind of an informal agreement where, for example, I have a business and I go to Staples or Office Depot and I say, can I open an account because I'm going to be in here 3 or 4 times a month buying office supplies, and rather than having to pay cash each time, if I could open an account at the end of the month, you could send me a bill, and then typically with an account receivable, you have to pay within 30 days. They give governments, like local governments and city governments, a little bit more time. Governments have more paperwork, so they'll typically have 60 to 90 days to pay their bills. Okay, and then 30 days we pay our bill. And typically you don't charge interest on an account receivable unless it becomes past due. A note receivable, on the other hand, is a more formal contract where the borrower signs what's called a promissory note. I believe that's the correct spelling. Okay, and they're promising to pay back the amount borrowed at a particular point in time in the future at a particular interest rate. So a note receivable generates interest from the moment the note is signed. 3 different transactions create a note receivable. The first is if I'm selling an expensive item, for example. I'm selling a piece of equipment. I may have the customer sign a note, and they may pay it off in 3 months, 6 months, 5 years. So a note receivable can be a current asset if it's due within 1 year or less. It could be a non-current asset if it's due beyond 1 year. In fact, some notes, which you have to pay in installments, will have a current portion and a non-current portion. We're going to focus predominantly on current assets, a note that is due within a 1-year time period. Okay, so a sale could produce a note. Debit note receivable, credit sales. Or I could be making a loan to a customer, in which case I would debit notes receivable and I would credit cash. And the last transaction would be what's called an accounts receivable conversion. And here's what this means. For example, suppose a customer of mine owes me $1,000 and they call me up, the receivable is just about due, they have to pay me back, and they say, I can't pay, I don't have the money, times are tough, can you give me a couple of more months? And I may say to them, sure, but what I'm going to do is I have to charge you interest because I could have been earning interest on this amount, but now I'm not going to collect it. So I'm going to give you an extra 3 months, but I got to charge you 5% interest. So what I would do is this. I would take it out of accounts receivable by crediting accounts receivable, and I would debit notes receivable. And so now this receivable is out of accounts receivable and it's in to notes receivable. That's an account receivable conversion. We're converting an account receivable to a note receivable. We're giving them more time and we're charging them interest. Okay, so let's take a look at an example of a note receivable. And the example we're going to use is a loan. We're loaning a customer money. I'm going to clear the board here. They have signed a promissory note, and on November 1st, we loan a customer $80,000 for 6 months at 6% interest. If our fiscal year end, the end of our business year, is December 31st, then we have 3 important journal entries. On November 1st, when the loan is made. Okay, and that's a simple journal entry: debit note receivable, credit cash. December 31st, at the end of the year, we prepare our financial statements, and using accrual accounting, we have to accrue any interest we've earned up to that point in time, even though we're not going to be collecting anything until the due date, which happens to be May 1st. We call that the maturity date or due date, and that's when we collect the loan principal. The loan principal in our example is $80,000 plus all 6 months interest. Okay, so let me create a timeline. As you can see, I like to use these. They provide a good visual. Here's November 1st. November, December, January, Feb, March, April, etc. Here's November, here's December, here is the end of the year, December 31st, January, Feb, March, April, May. Okay, so in the year 2010, 2011, we will have earned 2 months interest. Hopefully you can see that. So we have to accrue 2 months interest at the end of the year. So we need to calculate how much is 2 months interest. Okay, so November 1st, when I make the loan, my journal entry is debit note receivable, $80,000, credit cash, $80,000. December 31st, and this is an adjusting entry, I have to accrue interest that I'm owed. I've earned it. I'm not going to collect it till the following year, so I'm going to have interest receivable. We mentioned that at the beginning. And I'm going to have interest revenue because I've earned it. We recognize revenue in the time period that we earned it. Revenue recognition rule. Okay, so how did I get $800? Well, I multiplied 80,000 times my 6% interest. And remember, whenever we see an interest rate, we assume that it is an annual interest rate unless you are specifically told otherwise. And we've only seen one other exception to this rule, and that's when we took advantage of a sales discount, terms 210, net 30, or something along those lines. That 2%, if we paid within 10 days, that was not an annual interest rate. Okay? This is an annualized interest rate. So I multiply 80,000 times 6%, and my annual interest would be $4,800 if this loan were outstanding for a full 1-year period. But it's not. It's a 6-month loan. Okay? But under accrual accounting, I have to accrue 2 months interest, and so for the for the year of 2010, I have to record 2 months interest that I've earned. So I take my annual interest of $4,800, I divide it by 12 months, and that gives me monthly interest of $400. November, December, 2 months I've earned, so 400 times 2, I'm going to accrue $800 of interest. Debit interest receivable, which is an asset, goes on the balance sheet. Credit interest revenue, which is a revenue account that goes on the income statement. This is an adjusting journal entry. Again, I'm not going to collect anything until the maturity date on May 1st. But I'm going to record 2 months revenue in 2010, and then in 2011, I'll recognize the other 4 months worth of revenue that I've earned. But right now, it's December 31st. I've only earned 2 months. Okay? So there are the first 2 journal entries. November 1st, to record the note when we make the loan, and on December 31st, our year-end adjusting journal entry to accrue 2 months worth of interest. Debit interest receivable, credit interest revenue. Don't get these two accounts confused. One is an asset on the balance sheet, the receivable, and one is a revenue account that goes on the income statement. We close out revenue accounts. We do not close out receivables. So in our general ledger, I have a note receivable, NR, for $80,000, and I have interest receivable. And I'm not going to abbreviate IR since that could also be interest revenue, and we have $800. Now, if you prepared monthly financial statements, you could make a month-end adjusting entry for each month, but here in our example, we're only going to do one year-end adjusting entry. Okay? All right, so now it's May 1st, right here. And this is our due date. That's when we're going to be paid back the $80,000 loan plus all 6 months' interest. So let's take a look at that. My customer owes me a total of $82,400. $80,000 plus 6 months interest, and $400 monthly interest times 6 months is $2,400. So $80,000 plus $2,400. I debit cash for $82,400. Now, once we've collected everything, let's get these two assets off the balance sheet, or else we're going to think that they still owe us this money. If I don't get rid of these, I'm going to say, hey, you still owe me $80,000 plus interest, and they don't. So when we collect on a note, and we collect the interest as well, I have to credit the note receivable to zero out that account. And I'm going to do the same thing with the interest receivable. Since I only did one year-end adjusting journal entry, I have $800 sitting in the interest receivable account. So I credit both of these, and that's what these credits are here. Credit note receivable for $80,000, credit interest receivable for $800, and then my last credit in my journal entry is to credit interest revenue for $1,600, which is these 4 months, January, February, March, and April. I've earned 4 months more interest in 2011, so I have to recognize 4 months interest in 2011. And 400 times 4 months, $1,600. So total interest, 6 months interest, 2 months are in 2010, and we recognize those in 2010. 4 months are in 2011, and we will recognize the revenue right here on May 1st, 2011. Okay? So notice, I have 1 debit and 3 credits. But if you add up the amounts on the debit side and the credit side, they're equal. And that's what's very important in accounting. Debits must always equal credits. It doesn't matter if I have 1 debit and 3 credits or vice versa, as long as my debits equal my credits, and they do right here. Okay, hopefully that made a little bit of sense to you. I do want to make one last comment here, and that is we calculated interest on a monthly basis in this past example. We can also calculate interest on a daily basis. And I do want to point out that although there are 365 days in the year, a common banking practice is to assume for simplicity that each month is 30 days, and 30 times 12 would be 360. So sometimes daily interest is calculated using a 360-day year. I'm a little bit of a cynic. I also know that by using 360, banks earn a little bit more interest on their customers who they loan money to. And so that to me is the driving consideration, but that's just my opinion. Okay, so let's just calculate daily interest. Same exact information, and let's just tell you what, let's just use 365 days just for discussion purposes. So November we know has 30 days, and December has 31 days. So that's 61 days of interest that we earned at the end of 2010. To calculate daily interest, remember $4,800, that was my annual interest for a 1-year period. I divide that by 365 days, and my daily interest, rounded to the nearest penny, is $13.15. I multiply my daily interest by the 61 days, November and December, 61 days. 61 times 1315 gives me rounded $802, rounded to the nearest $1. And so my adjusting entry is going to be slightly different because instead of monthly interest, I calculated daily interest, but it's not off by very much. The first one with using monthly was 800. Here we came up with 802. Had I used a 30-day month, and a 360-day year, I would have come up with $800. Okay, and my adjusting entry, debit interest receivable, 802, credit interest revenue, 802. So we can calculate daily interest or monthly interest. It's more common for accounting class purposes to calculate monthly interest, but interest is one of those areas where it affects you in your personal life, and so I like to go through the calculations because whether it's your credit card, your car, your home payment, you can reconstruct the interest to make sure that you're not being overcharged. Okay, and that'll do it for today.